Hello and welcome to Earnings Echo. We put together the most important information about NVIDIA. Look, NVIDIA just dropped quarterly numbers that honestly would be the envy of literally any company in history.
Yeah,
I
absolutely.
mean, they added the equivalent of a Fortune 500 company's entire market cap to their valuation in a single quarter.
It's wild.
But, if you were watching the stock ticker after hours, you'd think they announced a rounding error. So let's dig into this deep dive. I want to get into the Q1 FY27 facts and figure out why the market yawned at an absolute blockbuster performance.
Well, the top line figures really are staggering. Revenue hit $81.6 billion.
Wow.
Yeah, that is an 85% year-over-year increase, beating consensus estimates by 3.2%.
Okay, and what about the bottom line?
On bottom line, non-GAAP EPS came in at $1.87, which is a clean 10-cent beat. They even guided Q2 up to an incredibly strong $91 billion.
Right, an 85% expansion and a $91 billion forward guide, yet, like we said, the stock barely flinched. Usually a beat like that sends shares into orbit.
Usually, yes.
It makes you wonder if those beat margins are starting to shrink. Is this signaling some kind of exhaustion in the AI rally?
I wouldn't say that. The muted reaction isn't about fundamental weakness at all. It is entirely about existing momentum.
Meaning it was already priced in.
Exactly. The market had already priced in flawless execution. So the magnitude of the beats was, slightly smaller than the massive surprises from previous quarters, but the underlying operational momentum is completely intact.
Which brings us to where that momentum is actually coming from. The data center segment posted $75.2 billion. That capital is flowing from somewhere, and I noticed they actually changed how they report this.
They did. They split the segment into two distinct buckets to give investors a clearer look at the engine room.
Okay.
Data center is now hyperscale, bringing in $38 billion, and ACIE, which stands for AI Clouds, Industrial, and Enterprise, generating $37 billion.
And there was a big jump in one specific area there, right?
Right. What's critical here is that sovereign AI revenue alone jumped 80% year over year.
That ACI split is just fascinating to me. It's like NVIDIA used to exclusively sell high-performance engines to Formula One teams, the big cloud hyperscalers.
Yeah, the big three.
But now they're selling those same engines to every regional transit system and local garage. It proves structural demand is broadening way beyond just Microsoft, Google, and Amazon.
Precisely. And while they are broadening that customer base, they are maintaining gross margins at an elite 75%.
Holding 75% margin at an $80 billion scale feels, I don't know, historically anomalous.
It's rare.
It almost makes you suspicious. Is this peak profitability before competition finally dilutes their pricing power?
Well, you might think so, but look at how management is allocating capital right now. They just authorized a massive $80 billion share repurchase program.
80 billion, wow.
They hyped the quarterly dividend to 25 cents. I mean, a leadership team anticipating near-term margin compression does not lock up that level of capital for shareholder returns.
Right, that is a very loud signal of internal confidence. Okay, so if they are that confident in the margins holding up, the future demand has to be bulletproof. On the earnings call, I heard leadership describe demand as parabolic.
They did.
That's a very strong word. What exactly is driving that next leg up?
The primary catalyst they cited is the shift to agentic AI. We are moving past the phase where AI just generates text.
Okay.
Agentic AI actively performs productive work and executes multi-step tasks across industries.
So from a compute perspective, generative AI is like asking a question and getting one answer. The compute is burned once.
Yes, exactly.
But agentic AI is like hiring an employee who continuously iterates, tests, and loops until a project is finished, burning compute the entire time. No wonder the demand curve is steepening.
Precisely. The compute intensity scales exponentially, which drives sustained hardware purchases.
And that massive compute burn naturally brings us to the $5.3 trillion elephant in the room, the enterprise value.
It is a staggering number.
When a number gets that high, my eyes just start to glaze over. To figure out if that valuation is actually justified, we need to look at a reverse DCF model. Walk us through how that works here.
Sure. So a reverse DCF, or discounted cash flow model, isn't a crystal ball. Instead of forecasting future cash flows, to guess a stock price.
Right, you take the current price and work backwards.
Exactly. It reverse engineers it to see what growth rate the market expects. Based on their $5.3 trillion enterprise value and an initial free cash flow of $96.6 billion, the model shows the market is pricing in a 21% compound annual growth rate in free cash flow over the next 10 years.
Meaning they'd need to hit roughly $650 billion in free cash flow a decade from now.
Right.
Maintaining a 21% CAGR for 10 years sounds wildly ambitious for a company already this massive.
It sounds high in a vacuum, but mathematically it is realistic given their current vector. Remember, NVIDIA is growing revenue at 85% today.
Good point.
From FY23 to FY26, their revenue CAGR was about 95%. Against the backdrop of an ongoing global infrastructure build-out, that 21% implied expectation is arguably conservative.
So tying this all together for you listening, the AI infrastructure supercycle spanning from the current Blackwell architecture to the upcoming Rubin platform isn't just a flash in the pan.
No, it's very real.
The evolution from generative to agentic AI is forcing a sustained hardware upgrade cycle that makes these valuation models actually pencil out.
And here's the final echo you need to take away today. NVIDIA is maintaining absolute pricing power. Right now, hyperscalers view compute capacity as direct revenue.
Because if they don't have the silicon, they literally cannot make the sales.
Exactly. As long as that dynamic holds, NVIDIA's runway remains completely clear.
Which leaves you with one critical question to mull over. If compute is now directly correlated to corporate revenue across every major industry, are we looking at a future where GPUs are treated less like tech hardware and more like a fundamental global utility similar to electricity or oil? Something to think about. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.